I don't pick technology stocks, I just own the market. For millions of investors, that is almost the definition of passive investing. Instead of trying to predict which company will win, they buy the S&P 500 or a total market fund and let the market decide. It sounds like the opposite of making a concentrated bet on artificial intelligence. But those two choices are no longer as separate as they might appear. In the paper underlying this documentary, 43.47% of SPY, one of the world's largest S&P 500 ETFs, falls within a broad classification of companies economically tied to the current AI cycle. That does not mean 43% of the S&P 500 is an AI industry. It means that, under the paper's broad definition, a very large part of a supposedly general market portfolio is now connected in different ways to the economics of AI. So the question is not whether AI is a bubble or whether investors should own these companies. It is something more structural. What happens when one technology cycle becomes so embedded in the benchmark that millions of people participate in it without ever choosing to make an AI investment? To answer that, start with what investors actually own. SPY is designed to track the S&P 500, so are IVV and VOO. VTI goes broader across much of the U.S. stock market. QQQ follows the NASDAQ 100 and is deliberately more concentrated in large growth companies. The paper classifies companies according to their economic connection to the AI cycle. Its broad category includes obvious infrastructure companies, but also large platforms whose products, spending plans, or business strategies have become materially linked to AI. Using that definition, broad AI exposure accounts for 43.47% of SPY. For IVV, the figure is 43.45%. For VOO, 43.27%. Different fund sponsors, almost the same result because all three are replicating essentially the same benchmark. Even VTI, with exposure extending far beyond the S&P 500, comes in at 38.41%. And in QQQ, broad AI exposure reaches 59.50%. There is an important qualification here. There is no universally accepted accounting category called AI exposure. Where the boundary is drawn matters. The paper therefore also constructs a much narrower basket, focused more heavily on the infrastructure at the core of the AI build-out. Under that stricter definition, SPY's exposure falls to 16.41%. That difference, 16 versus 43%, is a useful warning against false precision. Some companies are obviously central to AI. Others are large diversified businesses for which AI is only one part of the story. But the basic finding survives the classification debate. Exposure to this technology cycle is not confined to specialist AI funds. An investor can buy what they think of simply as the U.S. market and still acquire substantial exposure to the same group of companies driving the AI investment cycle. The reason has less to do with how many companies an index contains than with how those companies are weighted. Most major stock market indices do not give every company an equal vote. They are weighted by market capitalization. Imagine an index with two companies. One is worth $1 trillion. The other is worth $100 billion. In a market cap weighted portfolio, the first company receives roughly 10 times the weight of the second. Now suppose the larger company doubles in value. Nobody running the index needs to make an active judgment that it deserves more influence. Its market value has increased, so its share of the index increases automatically. That is one of the attractions of passive investing. The system does not require a fund manager to decide which company deserves to be promoted. Market prices determine the weights. But it also means that when a small group of companies becomes exceptionally valuable, they increasingly become the market portfolio. In SPY, the 10 largest holdings account for 37.28% of the fund. In QQQ, the top 10 account for 46.24%. So saying that an investor owns 500 companies does not mean their money is evenly spread across 500 companies. And there is another subtle point. When the price of a large constituent rises, an index fund does not necessarily need to rush out and buy extra shares simply because the stock became more expensive. The existing holding itself has risen in value, which mechanically increases its weight. But from that point on, new money flowing into the index is allocated according to those new, larger weights. And the performance of the benchmark becomes increasingly dependent on the companies that have grown to dominate it. There is a simple way to see how much that weighting rule matters. Take broadly the same group of stocks, but instead of allocating more money to larger companies, give every company roughly the same weight. That is an equal weighted index. The companies are similar. The weighting rule is different. And during the current technology cycle, that difference has been substantial. The S&P 500 gives us a useful real-world comparison. SPY tracks the conventional market cap-weighted index. RSP invests in the same S&P 500 universe, but weights the constituents much more evenly. The NASDAQ 100 has a similar pair, QQQ on the cap-weighted side and QQQE on the equal-weighted side. This is useful because these are not hypothetical portfolios constructed after the fact. They are actual traded investment products with actual returns. From 2023 through the paper's 2024 sample, SPY outperformed RSP by a cumulative 27.78 percentage points. For QQQ relative to QQE, the gap was even larger, 42.70 percentage points. In annualized terms, the average cap minus equal weight spread was 7.43% for the S&P 500 pair and 10.68% for the NASDAQ pair. That tells us something important, but also something limited. It tells us that during this market cycle, giving more weight to the largest companies made an enormous difference to investor returns. It does not tell us that artificial intelligence alone caused that difference. The same large companies associated with AI are also associated with other characteristics. They are mega caps, often highly profitable, often growth-oriented, and many benefited from momentum and a broader period of technology leadership. The paper tests several of those overlapping explanations. The cleaner interpretation is not that it has isolated a pure causal AI premium. It has not. The evidence is that cap-weighted products transmitted the performance of the dominant technology cycle much more strongly than their equal-weighted alternatives. For investors, that has been beneficial so far. The companies with the largest weights were also some of the market's strongest performers. But concentration does not only affect returns, it can also change where the risk in a portfolio comes from. Portfolio risk is not determined simply by counting stocks. Suppose you own 20 companies. If each one responds to completely different economic forces, the weakness of one may be offset by strength somewhere else. Now suppose many of those 20 companies depend, directly or indirectly, on the same investment cycle. They respond to semiconductor demand, cloud spending, expectations for AI adoption, capital expenditure by the same group of hyperscalers, and changes in investors' willingness to pay high valuations for future growth. You still own 20 stocks, but economically, they may not provide 20 independent sources of diversification. This is where correlation matters. Correlation describes the extent to which assets tend to move together. When large positions become more correlated, their combined contribution to portfolio risk can become considerably larger than their portfolio weights suggest. The paper estimates this relationship inside a specific universe, the current top 100 holdings of SPY. Within that model universe, companies in the broad AI group account for 57.48% of portfolio weight. But in the latest estimate, their contribution to conditional portfolio variance is 84.92%. That 84.92% is not a prediction of how much an AI crash would cost investors. It is not a forecast loss. And it is not an estimate for the entire S&P 500. It is a model-based estimate of where the portfolio's current variance is coming from within the top 100 universe. The distinction matters. A holdings table tells us where the dollars are. A risk estimate asks how those holdings interact when prices move. And in this case, the paper finds that broad AI-linked companies contribute considerably more to estimated portfolio risk than their already large weight would suggest. At this point, the obvious historical comparison is the dot-com boom. After all, technology dominating the stock market is hardly new. The dot-com era is often invoked whenever technology valuations rise rapidly. But using it simply as shorthand for another bubble misses the more interesting comparison. At the peak of the dot-com period, the paper calibrates technology at 34.81% of the S&P 500. That is already an extraordinary level of sector concentration. Today, the broad AI classification gives SPY a higher figure, 43.47%. But the important point is that extreme technology concentration itself is not historically unprecedented. Markets have been heavily dominated by technology before. What has changed far more dramatically is how people own those markets. Around the dot-com period, the paper's historical calibration puts the indexed share of long-term mutual fund and ETF assets at just 7.50%. In the current market architecture, that figure is 53.40%. That is a much larger structural shift than the difference between 34.81 and 43.47. 25 years ago, participation in a technology boom was more likely to come through direct stock ownership, actively managed funds, or an explicit decision to hold a technology or growth portfolio. Today, enormous pools of capital follow benchmarks automatically. Index mutual funds, ETFs, retirement savings, target date products, model portfolios. The benchmark has become infrastructure. And once that happens, a company does not need to be selected individually by millions of investors in order to appear in millions of portfolios. It only needs to become important enough inside the index they already own. That is where the comparison between dot-com and AI becomes much more interesting. The question is no longer simply whether technology is highly valued. It is how a technology shock travels through two very different ownership systems. The paper describes this transmission using a simple idea. Start with the share of a benchmark linked to the technology theme. Then ask how much investment capital is routed through index products. Then ask how much of household wealth reaches equities through those fund channels. Put those pieces together and you get a rough measure of how deeply a technology theme is embedded in the balance sheets of ordinary investors through pooled funds. The paper formalizes this as a public technology risk diffusion index. The name is less important than the intuition. A large technology weight does not automatically create widespread household exposure if few households own the benchmark through indexed funds. And a highly indexed financial system does not automatically create technology concentration if the benchmark itself is broadly balanced. It is the combination that matters. For the dot-com technology sector calibration, the paper estimates a household channel diffusion measure of 0.55%. For the current broad AI regime, the equivalent calibration is 5.57%. That is roughly 10.16 times the dot-com era value. But the wording here matters. This does not mean AI is 10 times riskier. It does not mean households will lose 10 times as much money. And it does not mean the model has examined every individual household portfolio. It means that, under this aggregate ownership channel calibration, broad AI benchmark exposure maps into a household fund channel roughly 10 times as large as the comparable dot-com calibration. The same pattern is even more pronounced in the paper's separate retirement channel. The dot-com calibration is 0.10%. The current broad AI calibration is 2.37%. Again, these two channels are not meant to be added together because household fund ownership and retirement fund ownership can overlap. But both point in the same direction. The market is not simply more indexed today. Indexing has become one of the main mechanisms through which households participate in the stock market. And that allows us to ask a cleaner question. What if the technology shock itself stayed exactly the same and only the ownership system changed? To isolate that effect, the paper runs a counterfactual experiment. It begins with the dot-com technology share calibration, 34.81% of the market. Then it imposes a 78% decline in the technology theme. That number is deliberately severe. It is designed to resemble the scale of the dot-com technology collapse. It is not a forecast for artificial intelligence. The purpose is not to say that today's AI-linked companies will fall 78%. The purpose is to hold the shock constant and ask how different ownership systems transmit it. Mechanically, a 78% fall applied to a 34.81% technology share produces a benchmark loss contribution of 27.15%. Now keep both of those numbers unchanged. Under the paper's 2000 ownership architecture, the calculated household channel loss is 0.43 percentage points of household financial assets. Map the exact same technology share and exact same shock through the current ownership architecture, and the household channel loss rises to 3.48 percentage points. Nothing about the technology shock changed. What changed was the financial system carrying it. The retirement channel comparison moves in the same direction, from 0.08 percentage points under the 2000 architecture to 1.48 percentage points under the current one. The paper then repeats the exercise using today's 43.47% broad AI exposure. With the same hypothetical 78% repricing, the mechanical benchmark contribution becomes 33.91%. Under the old ownership architecture, the household channel maps to a loss of 0.53 percentage points. Under today's architecture, 4.35 percentage points. Again, these are not predictions of actual household losses. They are mechanical scenario calculations. They do not model panic selling, fund outflows, liquidity problems, policy intervention, portfolio rebalancing, or an eventual recovery. Their value is precisely that they leave those complications out. They ask a narrower question. If the same technology shock occurs, how much more widely can it enter household portfolios when passive and retirement ownership are much larger? And in the paper's calibration, the answer is substantially more widely. That conclusion is easy to overstate, so it is worth being precise about what the evidence does not tell us. First, this paper is not evidence that artificial intelligence is a bubble. AI could ultimately justify enormous investment, produce substantial productivity gains, and create businesses whose current valuations look conservative in hindsight. The argument does not require the technology to fail. It is about the structure through which the financial consequences of success or failure are distributed. Second, the paper does not show that passive investing caused the rise in technology valuations. Index funds largely follow prices rather than set them. The fact that successful companies become larger parts of cap-weighted indices does not, by itself, prove that passive flows push those companies to unjustified prices. That would require a different causal research design. Third, the striking return differences between SPY and RSP and between QQQ and QQQE are not pure AI experiments. SPY beat RSP by 27.78 percentage points during the sample, and QQQ beat QQQE by 42.70. But the largest companies were not simply AI stocks. They were also mega-cap growth companies, technology leaders, and in many cases, unusually profitable businesses. Those forces overlap. The paper's more demanding statistical tests make semiconductor-specific attribution less clean, which is exactly why the result should be interpreted as evidence of broader technology cycle transmission rather than proof of an isolated AI effect. Fourth, the broad AI classification is inherently contestable. Under the paper's narrower definition, SPY's AI exposure is 16.41% rather than 43.47%. That does not make one number correct and the other wrong. They answer different questions. The narrow basket asks which companies are closest to the core AI infrastructure itself. The broad basket asks which major companies have become economically tied to the wider AI investment and adoption cycle. Fifth, the historical .com comparison is a calibration rather than a perfect reconstruction of every S&P 500 constituent and every household portfolio in the year 2000. The old and new financial systems are being compared using public aggregate data, not identical databases separated by 25 years. And the household channel estimates are just that, channel estimates. A value such as 3.48 percentage points is not a prediction that every household would lose 3.48% of its wealth. Individual portfolios differ enormously. Some households own no stocks. Others hold mostly equities. Some use active funds. Some own property, bonds, or businesses alongside retirement accounts. Finally, the model estimated risk contribution, 84.92%, applies only to the paper's current SPY Top 100 universe. It should not be presented as an observed future loss or a precise statement about the entire U.S. stock market. These limitations narrow the claim, but they do not make it trivial. The observed holdings show that AI-linked companies now occupy a large share of mainstream market portfolios. The observed ETF returns show that cap weighting has materially amplified the performance of the market's largest winners during this cycle. The risk model suggests that those companies may contribute more to portfolio variance than their weights alone imply. And the historical calibration shows that the system distributing market exposure to households is dramatically more indexed than it was during the .com period. There is also an important symmetry here. The same structure that distributes downside distributes upside. If AI generates extraordinary profits for decades, passive investors benefit without needing to identify the winning companies in advance. That is one of the core virtues of owning the market. The issue is not that index investing is somehow defective. It is that owning the market is not the same thing as owning an economically neutral portfolio. The market itself changes. Return to the investor we started with. I don't pick technology stocks, I just own the market. That can still be a perfectly rational strategy. A broad index remains far more diversified than betting everything on one company or one narrow sector. But diversification is not a permanent property of a ticker symbol. It depends on what sits inside the portfolio, how those companies are weighted, and how closely their economic fortunes move together. In the paper's current snapshot, 43.47% of SPY falls within its broad AI-linked classification. At the same time, the indexed share of long-term mutual fund and ETF assets has risen from a historical calibration of 7.50% around the .com period to 53.40% today. And when the paper holds a .com-style technology shock constant, the estimated household channel changes from a loss contribution of 0.43 percentage points under the old ownership architecture to 3.48 percentage points under the current one. Exposure, ownership, transmission. Those are separate questions, but together they describe an important change in modern capitalism. A technology boom no longer needs millions of households to actively choose the same companies in order to reach millions of household portfolios. It can reach them through the infrastructure of investing itself. That does not mean investors should abandon passive funds. It does suggest that fund providers, retirement platforms, and investors may benefit from paying more attention to forms of concentration that conventional sector labels do not always reveal. Top 10 weight, exposure to common economic themes, and how a portfolio might behave when its largest holdings begin moving together. Because a broad index can still contain hundreds of companies while becoming increasingly dependent on one technological era. And that is the deeper comparison with the year 2000. Perhaps the biggest difference between the AI boom and the dot-com boom isn't the technology. It's who owns it.